Today we find out why you should ignore dividends and focus on quality companies, and if Starbucks is a buy yet. Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Monday, April 15th, 2024 edition. I am Justin Klein, and happy tax day to all of you out there. Hope everyone filed their return or their extension and their payments to the Uncle Sam. Lord knows we need it, right? There's a lot of debt to cover and spending to cover, and we're going to get into that. It's part of what we're going to discuss later in the show. But first off, I want to preface this entire show with the fact that this show is about you. I'm going to bring topics to the table that I think are vital and important for you to understand and know more about. But ultimately, it's about equipping you with the right tools to make good decisions with your money consistently. So not just take a buy or sell recommendation you might hear. No, I don't want to say recommendation. Back up, SEC. Not a recommendation, but a slant of how we might view a particular stock or sector. And you don't take that as gospel, that you bring it back to your own personal situation, apply it accordingly, and what might make sense for one caller might not make sense for you, and vice versa. So this show is really about giving you the knowledge, the perspective, and as much data as we can give you in order to make good decisions with your money consistently. Okay, now, with all that said, we're going to talk about the market performance for today, run down the show topics for the entire hour, but as usual, we are going to hit our first caller question now.
Hey, Justin and Luke, I would like to know more about a company which I've been tracking for some time. It's RMBS, Rambus Inc. I see good support coming closer around the $56, $58. I would really like your thoughts on this company, and thank you so much for all your help. Appreciate it.
All right, looking at Rambus, this is a name that's been around a long time, just dragging the chart all the way back since I know it was the 90s. This is a name that was big during the dot-com bubble. It went IPO back in 1997 around, let's see, what was that? $6 adjusted, hit a high of $125 and change in 2000, and now it's at $59. So, you could see how it's very important to buy these type of names at reasonable valuations. And obviously, this was a name that was once again caught up in the dot-com bubble 1.0. Think of that when you are buying AI stocks today, for example, that there's oftentimes many of those names are going to peak probably the next year or two, and you'll never see those prices again, maybe in their lifetime. So Rambus is an example of that. Okay, it's never reached that peak that you saw back in 2000, the year 2000. Excuse me. Now today, however, Rambus is still in business. It's still a fine business, and it is a semiconductor company. It provides high-speed, high-security computer chips and silicon IP, and it's geographically diversified: U.S. exposure, Taiwan, Asia, Japan, Singapore, etc. So basically, U.S. and Asia. But if you look at the profitability, it's good. 37% is its current return on invested capital. However, my worry is that if you look back in history, these are flash in the pans. It peaks up into the 30s, but most of the time, its return on invested capital is negative. And that's what I don't like here, is the fact that, yeah, they made a bunch of money when people were buying chips, but now that growth is dissipated. Revenue growth last quarter was 0%. Quarter before that was negative 6%. Quarter before that, it was negative 1%. And earnings, while they're supposed to grow 47% this year, those estimates continue to come down. And the technicals look poor. This broke down in February. hit a high of 76 and change in January, broke down, I believe, on earnings in early February, and it has not recovered. It's still trading around $59 per share, actually at 59 to close today. So the technicals are weak, MACD divergence. This looks like it's heading for a downtrend, and I would be listening to that. So I would not be touching Rambus. It looks relatively attractive based on some of the numbers, but I want a business that is consistent, not a business that has flash in the pan years, good years, and then most years in negative profitability territory. I don't want that. So no, pass on Rambus. We have a lot of ground to cover over the next 40 minutes or so, and our main focus point is about dividend growth and dividends in general. Do they add value? I love this topic because so many people are in love with the dividend. Academics will say dividends shouldn't matter because it's simply a return of your capital. So we're going to discuss dividend growth, dividends in general, and tax-efficient investing as well. We're also going to discuss the trends that are happening in the bond market, the treasury bond market. We have a lot of debt issuance. And guess what? Some issues that we've been seeing over the past few years are starting to creep up once again, especially in the face of hotter CPI prints. So we're going to look at that story. Also, the boomer generation. They're the ones now mostly in retirement. There's still some boomers that are working, but the majority are in retirement. And most people in retirement, once their children leave the nest, they tend to downsize. But the current boomer generation is not doing that. So we're going to talk about those numbers and how that could impact the housing market. And then bank earnings. Bank earnings started on Friday with JP Morgan, Wells Fargo, Citigroup, and we're going to discuss those as well. So that's what's on the docket for topics. We're also going to touch on your voice bank questions. One is on YieldMax ETFs. I love this one as well. This one's great. And VTI, Vanguard Total Stock Market Index. And of course, I have some questions that come from our YouTube channel as well. And of course, your finance and investment questions are welcome live right now at 888-99-CHART, or we love your voice bank questions. Leave your question. If you're listening after hours, no big deal. Leave that question on that voice bank and we'll answer it on an upcoming show. Now we're going to a short break. On the other side, we'll talk about today's planned topics and talk about the market activity that we saw today. Definitely a red day, and we'll discuss and unpack that further. But you can call anytime and leave your questions on the InvestTalk voice bank, or if you're listening via our live stream or on AM 1220 in the Silicon Valley area, you can call right now at 888-99-CHART.
You are invited to be a part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors. Let's go to Mark in San Diego looking at Philip Morris, PM.
Yep, I own it. Long time. Was wondering if it's time to let it go or just hang on for the long term.
No, we like Philip Morris. This has the leading smokeless tobacco brand in the world, and it's right now I think it's there's two things weighing on it. One are higher rates, and the second is the higher dollar. Remember, Philip Morris International is just that. It's an international business. It's revenue is almost entirely in other currencies. And so when the dollar is strong, that tends to weigh on the price. But I think it's actually a great value here, under 90. I see no reason to sell it.
Okay. Thank you.
Thanks for the call. Let's go to Cameron in Philadelphia looking at Wire, WIRE.
Hi, yes, Justin. Thanks for taking the call.
Sure.
Yeah, so Wire, it had something interesting happen today. It was purchased for $290 a share, but the stock rose up to almost $295 at one point. I have a small position, so it's not a make or break for me or anything, but I was just curious, why would it go up that high? I do know it has a pretty high short interest. I was wondering if that maybe played something into it.
That could play into it. We actually own this for clients as well. So obviously a nice day for Wire. Closed the day on Friday around 260. And like you said, the buyout offer is at 290. Actually closed the day a little bit above that, 291.23. And to us, this is a signal that there could be a potential bid that is higher than 290. And that's what the market typically is saying when it's trading above that buyout level. And so we are actually going to be holding this for a little bit because we see very little risk that this deal will fall through, and a better chance that there will be a better offer, especially based on the business that this is in. One of the reasons we own it for clients is their business is doing really, really well. They make electrical wires and cables, and in the world where everything is electrifying extensively, their wires are desperately needed. And so I could see another company, especially maybe a more domestic company, coming in and bidding up for Wire. So we're going to hold on to it because I think there's still a little bit more upside potential and very little downside potential from here.
Okay, yeah, that sounds good. I was wondering all that myself, and it did seem like, there's not much risk in just holding. I think there was maybe a month long till they have a month to accept any new offers. So
yeah, exactly.
Seemed like it's worth just holding for a while.
Yeah,
great.
Yeah,
Thanks so much.
Thanks for the call. That was WIRE, Encore Wire Corp. Now let's take a look at the market today. It was, despite that buyout in Wire, it was a pretty red day in markets, but mostly on the growth side of the market. Large cap growth down over 2%. Large cap value only down about 0.28%. So about 170-ish basis point difference between what happened in the large cap value space versus large cap growth. So really that's where the intensified sell-off came. Tesla was down 5.6%. Is this a new 52-week low for Tesla? Let me pull up a chart here. Ooh, it is close. Yeah, I think this is a 52-week closing low, almost. Yeah, so the lowest level since May of last year. So getting there, but certainly absolutely in a downtrend that I think has a lot longer to go. I think you're going to see double digits for Tesla by the end of the year. Rivian also down 8%. Apple's down 2%. NIO down 5%. Ford down 3%. So all the EV type names certainly taking it on the chin overall. Amazon down 1.3%. And a pretty interesting day as we had the geopolitical tensions ramp up over the weekend. What was interesting is that gold and oil actually were down a bit today. I guess they did rally late in the day, but they were down early and rallied throughout the day, but not that big giant spike that you would expect from what happened over the weekend with Iran and Israel. But it's just showing you that, these tensions are unlikely to escalate, at least in the near term. Okay. Now we're moving to a quick break. Still to come on this podcast. We'll tackle YouTube questions and your voice bank calls. Stay with me for all of that and give us a call at 888-99-CHART. Hey, InvestTalk community. Justin and Luke here. We are so thankful you've been with us through this investing journey, but we are just getting started.
That's right, Justin. We're excited to bring you more exclusive content. Think more of the critical analysis and expert advice that you love.
You'll get insights into smart investing strategies to help you navigate these turbulent times.
Don't miss our live Q&A sessions every weekday at 4 p.m. Pacific, where we answer your burning investment questions.
Just call our InvestTalk listener line at 888-99-CHART, leave your question, and we'll tackle them on the next show. Who knows? Your question could be the next big topic we explore together.
So stay tuned and call 888-99-CHART to leave your comments. We're here to make investing accessible, understandable, and hopefully even a little more fun.
Chart your path to financial freedom here with the InvestTalk podcast. Let's go to Mike in Utah, and he's looking at PWR, which is Quanta Services. You own it or looking to buy it?
I own some, and I'm wanting to add.
Okay. Well, I think you're in a pretty solid name, $36 billion market cap. They provide specialty contracting and related services to electrical power, gas, and oil pipeline industries, areas that I think will continue to be strong, really no matter what the economy does, because we just need all of that, the expansion of our electric grid. And obviously, we are now the largest producer of oil in the world. And so, the shale business continues to chug along, and Quanta certainly benefits from that. Now, it is pulling back with the overall market here. And I'm assuming what you're trying to do is find a level to potentially add to it, correct?
Yeah, good buying point. It's pretty high right now, but I feel like it's a strong company, and it's good to just invest in.
You're right. It is a strong company and in a strong business, although no business is without its volatility, especially in the equity space. So I do think it is ready to pull back here. I'll give you a number, 223. Right now it's at 240, call it $249 to close today. And 223 would be that first major support level. The next would be about 210. So between 223 and 210, that's where I would start to add to your position a bit more.
Okay, awesome. Thank you, Justin. I appreciate it.
No problem. Thanks for the call. That was Quanta Services, good business, and that's those are some good support levels if it gets there on this market pullback. Which, and I didn't really hit on that too much at the start of the show, but I do think we are in the midst of a modest market pullback. Nothing too dramatic. Maybe we get to 4,800 on the S&P. I think that would be major support. Right now, we're close today at 5,061. So you're talking about another 4 or 5% from here. Remember, these are normal levels of volatility for equities. You should always expect a 10% pullback in equities in any given year. That is normal. Get used to it. All right, now my focus point today is about dividends. Dividends and whether or not dividends actually add value. If you talk to any economist, any professor in the world of finance and investing, they'll say that, dividends shouldn't matter, even though retail investors have a behavioral bias towards dividends. And the reason why dividends shouldn't matter is because it's effectively a return of capital to shareholders. And you could argue if it's a taxable account, you don't want it. They don't want to pay a dividend. You want to pay that tax on your own time, not forced to pay tax on that every dollar dividend that you receive each year. And so the question is, do popular strategies like dividend aristocrats, do they actually add value? Now, if you look at the numbers, they certainly do, especially if you compare it to the S&P 500. Since 1989, there have been 6 calendar years of negative performance for the S&P, and in all 6 years, the Dividend Aristocrat Index outperformed the equity benchmark by an average of 13.28%. And 3 of those 6 years, it actually was positive. Now, in up markets, it lags. It underperforms 56% of the time. But the fact that it holds water much better during downtimes means that overall long term it outperforms. But correlation is not causation. Just because it outperformed doesn't mean that it's because of the dividends, because the dividends are only one factor. There are other factors that explain performance of Dividend Aristocrat fund or index, or even the Vanguard Dividend Appreciation Fund, which is a popular fund. There are other factors like the size of the companies in the portfolio, the value of the companies compared to their true value, momentum, as well as, most importantly, quality, the quality of the businesses. So is it the dividends that are holding up the funds and making them these indexes outperform? Or is it the business that underlies the dividends? And the numbers are pretty clear. It's the quality of the business. Dividends are neither positive nor negative from a pre-tax perspective. And you can easily argue that if you're only focusing on dividends, well, you're less diversified. Why? Because 60% of US stocks don't pay a dividend, and 40% of international stocks don't pay dividends at all either. So it leads investors to be less diversified, focus only on certain sectors that tend to outperform. Think of utilities. Certain sectors that tend to underperform. Utilities, long-term, definitely underperform, but they pay consistent dividends. So the dividend growth strategies are basically quality strategies. Now, the quality factor is that premium that outperforms over the long term by about 4.8% per year. So don't focus on dividends, focus on quality. Give us a call at 888-99-CHART.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation. Do you want to take your investment strategy to the next level?
We invite you to visit InvestTalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to InvestTalk.com, submit your portfolio, and let us help you on your journey towards greater investment success. Thank you for watching. Make sure you like, subscribe, and hit the notification bell so you never miss an episode of the InvestTalk podcast. On the next InvestTalk, we'll look into this question. Why is inflation still so sticky? You can start by blaming rising housing costs and higher gas prices. Then add the cost of shelter. That tomorrow. But from time to time, we receive InvestTalk questions from our YouTube comment section over on our InvestTalk channel. And here's one that came in. Ulam Spiral says, what's going on with Starbucks? Stock flat for 5 years. Is it a buying opportunity? I'm concerned about China exposure. Well, you kind of answered your question to a degree, right? This has been in a downtrend. And you know, it was interesting. I was looking at an inflation chart of fast food restaurants over the past, I forgot the time frame. I think it was 5-10 years, something like that. And, you know, it was near the top of the list was McDonald's. They've almost doubled their prices over that time period. I'd have to go find the chart. But Starbucks was near the low end. And so, you know, they haven't been able to pass along a lot of these rising costs to the consumer. It's still a good business, but it was priced kind of to perfection for a while. And I think it's going through a period where people are maybe spending a little bit less on their lattes. And, the multiples were, like I said, just too high. Let me pull it up here. Enterprise value to EBITDA right now is at about 14. And it was, a high of 47. Whew. It was pretty expensive back in 2021. So it's kind of right sizing, getting back down to its longer term. It does trade kind of in the low to mid teens in an enterprise value to EBITDA range. And so it's there. It's there. It's at that level. So I think at this point, it's probably fairly valued. It's obviously a very, very good business. But the downtrend, I don't like. And there's been a lot of, Starbucks employees banding together and unionizing. And, that has, I think, weighed on their business. And I think the market is a bit worried about that. And so I would continue to have it on your watch list. Absolutely. We have it on our watch list. But I would need it to turn around technically or hit some major, major support. And frankly, the next major support, it's kind of at it, frankly, right around 83, 82 range. Right now it's at 85 and change. And so, do you get a reversal from here? Potentially, that could be a sign that you want to buy it. But ultimately, when you have these things in strong downtrends like Starbucks is in, you want to look for high volume reversal, high volume capitulation, and you're just not seeing that. I see no spike in volume. I just see a gradual grind lower. And frankly, I don't see major support until about the $70 level, $70. And that's where we'll get very interested in it. But until then, you just keep it on the watch list and watch for a potential reversal. And until then, you just wait. Thanks for the call. Or thanks for the YouTube comment. And to that end, let's fit in another YouTube question. Jim Leahy says, what do you think of WTS Waters Technology? Now, this is a name that's been a strong uptrend, but that uptrend has been waning. It did spike lower in mid-February, and it hasn't been able to recover that high. So from the near term, it is definitely in a micro bearish pattern on the charts. But the business is very strong. They make water, conservation, quality, safety, and flow products for plumbing, heating, end markets. And my issue mainly with this is the valuation, because it's not the business. The business is very good. It's a very high quality business. Return on equity is sitting right around, let me see here. I have it. There we go, 20%. And it's a very good business. Very, very little debt. I like that. But it's just trading too expensive. Now, let me give you a number. Trading at 199.65 today. If this gets to 170 to 175 in that range, that's where I'd pick it up. Okay. But thanks for the comment and good company. Just, the chart has to line up here, and it's not doing that right now. Now let's talk about the bond market, the American bond market, the Treasury market. Exciting stuff. Historically, it's a boring topic, but in today's world of so much debt, it is really a number one. It's probably the most important finance topic in the world today. Why? Because Treasuries are the bedrock of the financial system. They are the risk-free rate. They are what other debt instruments are indexed against, usually. If you have a mortgage, you're getting a mortgage, the reference rate is usually the 10-year Treasury. But recently, you've had pretty poor demand for some auctions. $39 billion in sales of 10-year Treasuries, as well as auctions for 3 years and 30-year Treasuries. And that has pushed the 10-year up to, let's see where we close today, 4.378%. So we're hanging around the 4.5% range. Treasuries peaked out around 5%. So we're not far off from that peak back in the fall. And going forward, governments are supposed to sell about $386 billion just in the month of May. just the month of May. And that's going to need to be absorbed onto some balance sheet. Now, in the first 3 months of this year, U.S. sold $7.2 trillion of debt, the largest quarterly total on record, even higher than the second quarter of 2020 when we were issuing a ton of government debt for COVID stimulus. And so what the Treasury is likely to do is stay issuing on the short end. And they've already done that, though. And they're kind of pushing up against the limits, their quoted limits of how much, what percentage of debt issuance will be on the short end versus those longer dated securities. And longer dated securities have more risk. You've seen that. Go look at a price of TLT or IEF. Those are longer term Treasury ETFs. And you've seen they're down dramatically over the past couple of years. So when you go and buy those, or anybody goes and buys those, they're taking on duration risk. And the last couple of years, duration risk is bad. Now, it could be good going forward. Just because it was bad the last couple of years doesn't mean it has to be bad. But there's clearly risk there. When you're buying 3-month treasuries, there's pretty much no duration risk there. Okay? Now, debt is expected to go from $28 trillion today to $48 trillion by 2050. That's up from $13 trillion just 10 years ago. Now, a record $8.9 trillion of treasuries are set to mature just this year. Now, all that does is pull liquidity out of the market. And right now, you're actually seeing some liquidity being pulled. That's what a catalyst for this market pullback, I think, is people were parking money in treasuries. Now they have to take that money out to pay taxes. But going forward, if more money flows into treasuries, that's less money for people to go out there and spend. And so what happens with the Fed going forward and the Treasury are far more important than the Fed funds rate. What the Fed does, are they going to raise rates or lower rates? It's a sideshow. You need to ignore that pretty much. It is now secondary to how the government is going to finance themselves. Whether QT is going to end or slow, far more important than if the Fed is going to raise or lower interest rates. Whether the Treasury issues more 10-year and 30-year bonds or 3-month and 6-month bonds, those factors are far more important to the market and liquidity, at least near term, than is the Fed going to cut rates or not. Now, I will say this. This may sound alarmist when I talk about this, but the reality is that near term, there are tools that the Fed has and the Treasury has to quell any problems. And you're starting to see some problems arise. The MOVE index is something that I follow pretty much daily. It's the volatility index, the VIX of the Treasury market. And when it gets above 150, there are problems, major problems in the Treasury market. This happened back in the banking crisis last year. And it's been in a steady downtrend ever since. And hit a low just at the end of last month, around 85. But it is April 15th. We are only halfway through April, and that MOVE index is at 121. That is a fast move. A very fast move. And the question is, how fast will it get to 150? And guess what? I don't care what happens with interest rates. I don't care what happens with inflation. If this gets above 150, the Fed will stop QT. They may lower interest rates. They will do something to prevent the market from coming undone, the Treasury market. So this is the most important topic to follow in markets. It's not the most interesting. It's not the most exciting, but it's the most important. But like I said, they have tools. They will use them, but it will create market volatility in the near term. But it also pretends to higher inflation, higher interest rates going forward. Now, this is InvestTalk, now with more than 58 million downloads. Let's keep things moving and play another caller question from 888-99-CHART.
Hello, my name is Dave from Finger Lakes in New York State. Calling about YieldMax dividend ETFs. I know you say don't chase dividends, but I've invested in these dividends ETFs and done very well. I was wondering if you could share your thoughts on YieldMax. Tell me what you think. Thank you so much.
Well, there's a litany of these YieldMax ETFs, and they typically are single stock covered call ETFs. So they are. They have them on all the major companies, Amazon, Tesla, Apple, Google, etc. And I've said this always about any covered call strategy, whether it's a whole portfolio of stocks or individual stocks like this. It's all about the underlying company. Is the underlying company going up or is it going to go down? Guess what? Tesla has been in a strong downtrend. And what has TSLY done? It's been in a strong downtrend as well. TSLY peaked out in July around $37. Now it's at $14.57. Paid a dividend over that time. I don't know what it is, but it didn't matter whether you got that dividend. It hedged you a bit on the downside, but ultimately, it's an expensive covered call. You can run your own covered call strategy. Why do you need this? You're paying these charge over 1%, 1.01% for TSLY, the Amazon one. I could bring them all up, but I'm assuming all of them are going to have around this 1% expense ratio. Guess what? We run a cover call strategy with individual names. You can do it yourself, especially with one individual stock. Not hard. It's one stock. This isn't a portfolio. We run full portfolio, and we're monitoring each position, and sometimes we're switching out positions for another. It's a process. It's a daily work. Running a cover call strategy on an individual company is not hard. You should not pay 1% for this. Just do it yourself. Go buy 100 shares. Some of these even have, I think, micro options where you can only buy. You can sell options on 10 shares. So there's nothing special about these. You're chasing the dividend. You're not chasing the strategy. Because the strategy you could do yourself. There's nothing special about that strategy at all. But you're going to charge 1% for one stock. One. That's it. So knock yourself out if you want to. But once again, it's all about the stock. The one on Tesla is going to do terrible because Tesla is in a strong downtrend. The one on some of the stronger names, Apple, Google, etc. If the stock goes up, they'll do well. But in the end, cover call strategies just lower the overall volatility of whatever strategy you are deploying. And so these YieldMax ETFs, the strategy is buying one stock. It's not a strategy. Now we're moving into a break. I'm ready to take your calls at 888-99-CHART. Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors.
Is something on your mind? You can call us 24/7 at 888-99-CHART with all of your finance and investment questions.
Hi, Justin and Luke. I'm calling about Digital Realty Trust, ticker symbol DLR. I heard Luke talking lately about REIT, and I used to own this company, and I pulled out of it. And I'm wondering if it's time to start up a position again. I don't know what you think about the fundamentals and maybe a good entry price. Thank you very much. Have a good day. Bye.
All right, Digital Realty Trust. This is a data center REIT, one of the largest ones out there. And we used to own this for clients as well. However, we recently sold out of it also. And mainly because we didn't like the cash flow numbers, the profitability numbers weren't kind of adding up. And we thought that the hype around the growth of data centers and the profitability of those data centers was a bit overblown. And so we decided to really just move this capital elsewhere. Now, this is just started to peak back in early March, and now it just closed today for the first time in a while below its 100-day moving average. So I don't love the technicals. The technicals look pretty poor, and I think the AI hype is fading across the board. Just look at NVIDIA, right? NVIDIA's momentum has slowed, SMCI, et cetera. All of these the AI craze is peaking just like the Zoom craze peaked back in 2021. So I think that this is a name that needs to come in a lot more, and the throughput of cash flow needs to happen as well for me to get excited again about Digital Realty Trust. So I would keep on the sidelines for now. Now, lastly, we're going to touch on bank earnings. Bank earnings started on Friday from JP Morgan, Wells Fargo, and Citigroup. Now, they all reported better than expected earnings and revenues, but there were some signs of issues, mainly around net interest margins. Now, consumers and businesses are healthy. Said that for a while. When you are in an inflationary environment, most people and most businesses, they do better in that scenario because there are a lot of fixed costs. Think mortgages, those that are in the middle to high income earners, they tend to do better in an inflationary environment. Like I said, a lot of fixed costs. But if you're in the lower end of the income spectrum, you tend to get hurt the most. Why? Because that higher inflation tends to eat into your disposable income a lot more. And so that's why you're seeing dollar stores having issues and kind of on the low end. But the vast majority of the economy and corporations, they're doing fairly well. Now, JP Morgan said its first quarter profits rose 6%. Wells Fargo, that was up down 7%. And Citigroup was down 27%. So JP Morgan, I've said this for a while, if you want to invest in a bank, the big boy, the behemoth, the best run out there is JP Morgan. Now, that didn't prevent JP Morgan shares from falling 6.5%. Why? Because they were priced for perfection. So it's not just about who's the biggest, but what is the market expectations that's built in. Now, overall, the KBW NASDAQ Bank Index fell 1.5% on Friday. Now it's down 6.5% just this month. And while these are the big banks, what's most important are those medium and small banks. And that's coming up later this week and next week. Because they are more exposed to where the weakness is in the banking environment. And that are net interest margins. Like I said, it shrank for JP Morgan for the first time since 2021. And it fell for Wells Fargo and Citi as well. So what's happening is people continue to chase those higher rates. They're not allowing their money to sit interest-free in their checking accounts anymore. And remember, these large banks, they have investment bank arms. So they're doing M&A and they're helping issue equity and debt offerings, et cetera, and they're earning fees on that. Your medium and small banks, they don't have that. They're pretty much entirely dependent on their net interest margins. And they have a lot of exposure to that commercial real estate. So while it's interesting what's happening with the big banks, it's kind of known. Those are steady. They're solid businesses, not amazing. But the real issues lie with those smaller banks, and we'll see coming up here in the next week or two how they have fared. Well, that about does it. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well, and tell your friends about the InvestTalk podcast, now available in video form on our YouTube channel. Just search InvestTalk. Remember, that's with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461. Steve Peasley is president, and Justin Klein is chief executive officer of Klein, Pavlis, and Peasley Financial. Thank you for listening, and your comments and questions are welcome on our 24-hour listener line at 888-99-CHART.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.